I'm pleased to kick off iDay with an impactful topic. For the last 15 years, companies and technologies generally known as Insurtech have been disrupting and shaping the insurance industry. Companies like Hippo, Lemonade, Root, and Next, along with countless others, are bringing advanced technology to the challenges facing insurers and their partners. Our two guests this morning play leading roles in innovating and adapting in a rapidly developing market. As new risks emerge and AI dislocates functions within the insurance value chain, I'm sure we have a lot to learn. Rick McCathron is the president and CEO of Hippo Holdings and has been a board member for a very long time, actually, since 2017. Before Hippo, Rick held senior executive positions at various insurance companies, including First Connect Insurance as president and CEO, Superior Access, and Mercury Insurance Group as regional vice president. Rick is both a chartered property casualty underwriter and a certified insurance counselor. He's an advisor to several insurtech companies and holds a BS in finance from Oregon State University. In addition to this impressive resume, I am proud to call Rick my friend and business partner. With that, I will turn the floor over to Rick to tell us about Insurtech's impact on the insurance industry and how Hippo fits into that equation. Rick?
Dr. Russell, thank you so much, and thanks for joining us here. Despite our casual Insurtech attire, we all wear t-shirts and jeans every day, unlike David, who's wearing his tie. But we are staffed with a blend of insurance professionals at Hippo and technologists. And so, as David mentioned, I've been doing this a long time, 32 years in the industry, and was really excited about the opportunity to join Hippo nearly 10 years ago when we started the company. I was part of the original founding management team of the company, and fast forwarding, we're now a publicly traded insurance company on the New York Stock Exchange under the call sign HIPO. One of the things that I think is critical as we start going through the process is how do we evolve the insurance industry? You'll hear other insurtech companies talk about things like disruption. You'll never hear me say that because I think disruption signifies that you need to change something that's broken. And I do not believe the insurance industry is broken. I do believe that the insurance industry could benefit from modernization, and much of that modernization, the genesis of it comes from insurtech companies. Insurtech companies are more willing to take risk. And I don't mean underwriting risk, although we take a lot of underwriting risk here at Hippo, but also operational, executional, regulatory, and product consumer fit risk to really understand what customers may want in the marketplace. So at Hippo, we not only manufacture insurance products that we sell both through independent agents, direct to consumer, and embedded solutions, but we are also a platform carrier for 35 other MGAs and insurance products offerings, including some very, very large, well-established companies like AmRisk, Accelerant, Coterie, MSI, just several others. So our platform, which takes risk across the broad perspective of insurance, all the way from property and casualty, also we're trying to modernize homeowners insurance through a more comprehensive product offering. So that's Hippo.
Great, Rick. You mentioned modernization. Can you elaborate on what you mean by modernization? As you said, you've been around a while, and so you've seen a lot of underwriting cycles, you've seen a lot of different business models. What does modernization mean in 2025?
Yeah, it's a good question, David. A couple aspects related to this. I think we need to think about three components when we're thinking about the insurance value chain. First component is customer. Second component is technology. Third component is underwriting profitability. Without really focusing on all three simultaneously, I think we're leaving opportunity on the table. Most insurtech companies started, and Hippo was no different, with the idea of how do we create an easier consumer flow for customers getting ready to purchase a homeowner's insurance product. And we modernized that experience by pinging dozens and dozens of third-party reliable data sources, plus some proprietary data sources, to eliminate the need to ask the customer questions that most traditional insurance companies would ask. If you go back to say, 2017, typical number of questions on a homeowner's insurance applications were near 100. What we did at Hippo was we were able to pull those answers from third-party data sources, and we could give a quote and bind a policy in under 60 seconds utilizing third-party data. That created a better customer experience, and frankly, we believe that it created more accurate data because oftentimes, some of those questions were things like, how close are you to a fire hydrant? What's your inner wall material? How old is your roof? Well, if you've just moved into that home, you have no idea the answers to those questions. So if we can get those questions asked and answered through verifiable data sources, we would do that. And we were quite successful. We grew significant market share in the states that we launched in very, very quickly. The second piece of that is the technology. And from a technology perspective, I think there's a couple different components that are important. One, the insurance industry are no longer filled with what I would call pure competitors. In almost every circumstance, a company that I would deem a competitor to Hippo is also a partner to Hippo. So if you look at large insurance companies, the Liberty Mutuals of the world, the Farmers of the world, the USAAs, the Progressives, there have been times in our histories where we have sold their policies, they have sold our policies. So creating technological interfaces with those various entities to make sure that each company is essentially getting the risk they want and recognizing that not all companies can be all things to all people. Everybody has a different view of what risk is. So building those seamless technological interfaces with partner companies is something that was very important in the early stages of the company and of the Insurtech industry. Also, utilizing IoT devices. Our view is quite simple. The best claims experience, the claim you never have. So shifting from reactionary to proactive prevention or at least mitigation of claims is something else that I think the Insurtech industry has brought to bear. We provide customers with IoT devices, smart water shutoff devices, and other aspects that help them reduce or eliminate the claim. The other thing that I think is important if we're talking about homeowners insurance specifically is homeowners insurance is only one part of protecting somebody's home. You also need warranty, you need services, you need maintenance, all these different aspects. And you're starting to see companies like Hippo, Porch, and others bring more of a comprehensive, holistic home protection mindset led by technology to create better outcomes for our customers. And then the third is underwriting profit. And this is the piece that I think most insurtech companies missed from the beginning, but most insurtech companies have fully embraced and have significantly improved their underwriting profitability. When you're a new company, that's funded by venture capitalists, you're very much motivated to grow as quickly as you can to get market adoption. Sometimes some insurtech companies cut some corners on things that those of us that are CPCUs and or have been in the industry for a long time would say is somewhat reckless. We used to at Hippo talk about you can't have a viable company unless you have an underwriting profit. However, what most insurtech companies, including Hippo, were trying to do was say, we're trying to create what the industry has created in 100 years, compress it and modernize it in 5 to 10 years. It takes time. Insurance takes time. Any changes you want to make, there's regulatory approval required. They typically take place at renewals. So it just takes time. But as you've seen the evolution of the public insurtech companies, the ones that Dr. Russell had mentioned, you're seeing almost all of us are now net income positive. We all have very favorable underwriting results, and we're all excited to look to expand and keeping that pedigree of insurance and underwriting, claims handling, pricing, and discipline as an equal ballast to the technology we're creating.
Great. Rick, I happen to know that you're originally from Southern California, so it would be dereliction of duty if I didn't mention the fires back in January. and who knows what's coming down the line. Um, do you have any comments on the homeowners market? Maybe not to get our regulators riled up, but any thoughts about wildfire in California and wildfire as a peril generally?
Yeah, I do. I have actually fairly strong conviction at the direction the industry should go. Typically, the industry's solution for things like this is to raise deductibles, to reduce coverage. I think earthquake is a great example. I was taking CPCU classes in the 20th Century Insurance office in Northridge, California. The week that the Northridge earthquake happened. And if you look back prior to the Northridge earthquake, um, earthquake coverage was a typical covered peril within a standard homeowners insurance policy. After the Northridge earthquake, companies reduced coverage, raised deductibles, and really eliminated a lot of the portion that they would pay for sort of first dollar loss in earthquakes. And then ultimately, some started to exclude it altogether. I think you're saying the same thing, frankly, and whether it's wildfire or hail or hurricane. I think the industry's knee-jerk reaction typically is let's let's raise rates, reduce limits, pass more of the cost via deductibles or limitations onto the customer. The challenge with that mindset is we already have an affordability crisis for homeowners insurance. It's critical for us to understand how do we rebalance that risk and exposure in a way that the customer can afford. So we have some very large partners within the home builder community. And if we look at an analysis of raising rates for home insurance in places like California, Texas, and Florida, it significantly reduces the amount of customers that qualify for the loan to buy that new home. And it's a small number. It's typically $500 a year to $700 a year, reduces dramatically those that would qualify for the loan to purchase the home. Raising interest rates is another thing that's creating that issue. So my firm belief is that we have to rebalance the triangle and not put the exposure on the back of the customers and also not put the exposure solely on the back of a single risk bearer. So my view is quite simple. I think certain related perils, like what happened to earthquake, are going to find themselves outside of a traditional homeowners policy. And there will be different risk pockets or risk pools, whether it's through the form of parametric insurance or through a separate policy, to remove that exposure from the standard policy into a different policy that is diversified globally for a whole host of weather-related claims and keeps the price down for the customer. And so I do think we're going to find ourselves in a situation where creative companies are coming up with solutions to help both insurance companies, primary insurance companies, reduce the fear of those large catastrophic losses, and for the customer to still have insurance coverage for their fear of those large catastrophic events, but they're going to do it through a different risk pool and a different balance sheet.
Well, that's certainly a good segue to introduce our next guest, who is Wesley Pergament. He is CEO and co-founder of Sola Insurance based in Atlanta, Georgia. Wesley comes from a technology background and began his journey in the insurance industry at a flood insurance startup where he had access to data that ultimately helped him envision a parametric insurance product. He'll certainly help us understand what that means. Sola has been approved in 15 states as the first ever admitted personal lines parametric product and is fully reinsured through Lloyd's of London. Wesley is a graduate of the Georgia Institute of Technology, and most recently, Sola Insurance has been named one of CB Insight's top 50 Insurtech companies for 2025. With that, let's hear from Wes about how he sees Insurtech and Sola's parametric insurance products making an impact on the insurance marketplace. Wes?
earthquake, or different hurricane events, or certainly as we're seeing different hail events, increase wind and hail deductibles, desire new types of coverage solutions. And so that's ultimately what we're trying to build at Sola. Obviously, attacking each peril has a lot of very specific circumstances to it. So whether it be tornado or straight line wind or hail or wildfire or earthquake or flooding, each peril has a lot of different dynamics to it. One, needing to understand a lot of the regulatory environment around the peril. Two, the private insurance market and how they're handling the risk. And then three is also just kind of the actual peril itself, like the frequency and severity of the peril itself. And so, specifically, we first started tackling tornadoes by using National Weather Service data to figure out where damaged areas occurred, and then ultimately have grown into hail, simply because also hail is a much larger issue than tornadoes, right? Tornadoes probably affect thousands of homeowners per year, and hail affects millions of homeowners per year. And as Rick was mentioning earlier, a lot of wind and hail deductibles that have been drastically increasing for homeowners, while also premiums going up. And effectively, even some wind and hail deductibles that are above the cost to replace the roof itself, meaning that the home insurance policy no longer covers roof coverage. And so we have built a product that uses wind and hail data that allows us to objectively figure out when a roof needs to be replaced. And as a result of that, we can greatly reduce a lot of the kind of fraud or manufactured roof claims that the traditional home insurance industry might have faced prior. And as a result of that, lower our loss ratios and then pass those savings on to the homeowner in the form of kind of more affordable natural disaster coverage.
So can you describe a typical policy you guys are manufacturing and what the economics look like?
Yeah, absolutely. So I think that the basis of the policy is really like if you take indemnity and parametric insurance. So indemnity is based off of indemnifying the loss. So that means a contractor goes out, estimates the value of the loss, the insurance company evaluates the claim, and then pays out the full value of the loss. The only problem is that those loss adjusting expenses become high, certainly for hail claims, for sending out adjusters. Like that process is expensive. And when you have your average hail claim at only $13,000, adjusting that claim is also, again, really expensive. And so as a result of that, you have created kind of situations where home insurance companies are in a tricky situation of how much time they need to spend evaluating a hail claim and whether it's a valid hail claim or a roof actually needs to get replaced, or maybe the roof is fine and needs to stay there. And so as a result of that, we need to figure out how to create kind of like a new insurance product with lower loss adjusting expenses, so that we can cover these $10,000, $15,000 claims. And so, while our product isn't completely fully
Wes, we may have lost you in
uh,
a,
oh,
Hey, David, maybe, oh, we got Wes back. I was
yeah,
gonna
we
go,
yeah.
got it back.
but go ahead, Wes.
Yeah, so sorry, I was just saying that yeah, ultimately, what we found is that a lot of these insurance companies, like loss adjusting expenses, are expensive and kind of start at a bare minimum point. And so when you have a $10,000, $15,000 claim, and the simple fact of sending out an adjuster, let alone the actual involvement of the whole claim, might start at $1,000 or $2,000. When you only have a $10,000 claim, that becomes a really expensive part of it. And so figuring out a way to kind of reduce loss adjusting expenses, specifically kind of for hail claims, is why we're able to do what we do at such an affordable rate for homeowners.
So
Yeah,
can you set us up with what a policy trigger looks like? Maybe even give us a hypothetical location in the US and how a SOLA product would respond to a loss.
Yeah. Oh, sorry. Can you repeat that question?
Sure.
Good.
So can you give us a hypothetical about the ideal policyholder for SOLA, and sort of the economics of the policy and how it integrates with the indemnity
Yep,
product and
absolutely.
what it might cost?
Yeah, absolutely. So our average coverage is for the average homeowner in the Midwest or Southeast. So this is our average policy that we sell is in that $10,000-$15,000 range. And so effectively kind of like roof coverage in a sense. Depending on where the policyholder is, depends on the premium, obviously. Like as we probably know, hail risk in Texas is much more significant than in Tennessee. So our average premium in kind of like Arkansas and Missouri is about $300 per year per 10,000 in coverage. In Texas or Oklahoma, it's closer to $700 a year per $10,000 in coverage. And then the way that this policy works in terms of how it fits in with the indemnity product is, as I mentioned before, a lot of these home insurance policies have carved out the wind and hail deductible. Um, what used to be a kind of flat rate, maybe $1,000 or $2,000 deductible, has now turned into maybe $1,000 all other peril deductible, and then a segmented out wind and hail deductible that could be $10,000, $15,000. And what's become kind of the percentage based wind and hail deductible. And so that percentage is a percentage of coverage A. So if you have a $500,000 home and a 1% wind and hail deductible, that's $5,000. But what we've been hearing from our agents in Texas, for example, the minimum almost is 2%. And so for again $500,000 home, that's a $10,000 wind and hail deductible, and that's just the minimum. Most of these deductibles are, like I said, 12, 15. I mean, some are even 20, $25,000. And so what homeowner or insurance agents can do with our policy is they can set the limit of our SOLA policy equal to the wind and hail deductible of the home insurance policy. And so in the instance that a hailstorm comes around and the roof needs a replacement, we will pay out kind of the full instance of our limit for that hail policy, so that the homeowner can get the roof replaced. And in a sense, I mean, the homeowner may never need to even file a claim with their home insurance provider if it was kind of just that roof that needs to be replaced.
One thing, David, if you don't mind, I'd like to add from a customer's perspective too, that it allows, let's say a company had a 3% deductible on the $500,000 example. So it's a $15,000 deductible.
Mhm.
The versus a 1% deductible at a $5,000 deductible. If they change the deductible, they get a premium credit on the homeowner's policy. And in many cases, the premium credit actually pays for the SOLA parametric product. And what you've substantially done is you have pivoted a portion of that weather-related loss to a different balance sheet, Lloyd's of London in Wesley's case. Yet the customer is paying similar than what they would have paid with a much lower deductible. So it really does rebalance that sort of triangle that I was talking about earlier on making sure that you can keep the customer whole, where they still have ample coverage for these types of loss, but you pivot a portion of that loss to a different balance sheet. And what I love about Wesley's business, I'm at Hippo, we sell in our agency, because we have an agency too. We sell this product alongside various homeowners policies. What I love about that product specifically is that from an underwriting perspective, as a risk manager, he's capping his claims on every single loss. So he knows if it's a $10,000 policy, he knows it's 10,000 they're paying out. Whereas you might have an inflationary period where a homeowner's insurance company thought a roof was 10,000 to replace, but maybe it's 15, 20, 25,000 now. Maybe they're surge pricing because it's after a massive event. So Wesley's product actually gets to cap their maximum payout on any loss. And the underlying homeowner's insurance policy doesn't have to pay that first portion. So it creates a bigger deductible, so to speak.
Got it. That's helpful. It certainly brings more capacity to the relationship. Wes, one thing that's maybe a mystery is how a parametric trigger activates or do you have to send someone out, or do you merely contact the National Weather Service and that triggers the payout?
Yeah, absolutely. So, I mean, parametric has been around for a while. The whole principle and then where the word came from is parametric meaning parameter, and so once a parameter is met, a trigger of a payout is delivered. Um, the only problem as it relates to parametric insurance or parametric and insurance is making sure that the payout is very highly correlative with the loss. And so there have previously been parametric insurance products that have been launched. And also, I would add, launched unsuccessfully, where they really didn't have a high correlation with the loss. Maybe, again, they were based off this one parameter, but weren't well correlated with the indemnification of what the loss would be. And so I think where parametric insurance works incredibly well is when you have a loss that has been validated, or a loss where, again, the payout is very highly correlated with the actual indemnity-based loss that the policyholder suffers. And so, whereas before, parametric insurance used to be great for maybe governments, for example, because let's just say you had like an earthquake or a monsoon or whatever in a foreign country, the government getting a payout to then provide as welfare to individuals usually worked out really well. But now, when you try to bring that down to the consumer level, you need to ensure that that loss has a really high correlation, or the trigger has a really high correlation with the loss that the individual suffers. And so, as a result of that, that's kind of why I mentioned previously that our product is a little bit of a hybrid of this kind of parametric and indemnity, where we'll still use weather data ultimately to like validate when a roof needs to be replaced. But we'll still have like homeowners submit videos and photos from the damage just to kind of further validate that there was like an insurable loss at that location. But ultimately, in terms of the data that we collect, it is everything related to a hailstorm, right? So it's hail size, hail diameter, even the density of hail. There's difference between like spongy hail and dense hail, and how that affects the roof and when it needs to be replaced. And on top of that, we'll also look at all the previous hailstorms that have hit that home, right? So a newly built roof can sustain the same hailstorm a lot better than a older roof that might have been hit by 3 or 4 previous hailstorms. So instituting also all of those variables within how our product works and when a roof needs to be replaced is also kind of really important to the construction or manufacturing of how the Solo wind and hail product works.
And so you use both publicly available weather data as well as these videos to document the fact that yes, indeed, the hail that might have fallen in that area did result in a claim, but you never actually send someone out.
No, yeah, we never send someone out, and that allows us to also, as I was kind of mentioning earlier, reduce our loss adjusting expenses and be able to handle these claims and in a proper fashion, while also being able to provide something affordable to consumers. And then in addition, we also take in property characteristics as well. So like I said, we have also a mix of public and private data sources to fully get like a holistic picture of like what the roof looks like and the conditions.
Got it. So you're currently mostly in the middle of the United States,
Yes.
but here in the Western U.S., we don't have as much hail and tornado exposure. Um, how should we think about a product like Sola's with the peril being wildfire?
Yes. So wildfire is a very interesting and more difficult peril to insure, as we all know and have seen with the recent disasters. I think there are a few things that we need to think about if we aim to build a product like this to cover wildfires eventually, right? Because there are other factors. Like if you look at the difference between hail and wildfire, there are a lot of other factors. So specifically, hail, for example, like if you are in northern Texas versus central Oklahoma, the hail risk generally is going to be the same. Whether if you're in California, there are a lot of different discrepancies to understanding wildfire risk. So like one home and then the community over can have completely different wildfire risk, not only because of like the geographic locations that they might be in and how close they are maybe to like a forest, for example, versus not close to a forest, but then also, as we all know, a lot of the things that homeowners can do to protect like the immediate perimeter of the home itself. So not having trees overhang or protecting the zone zero and putting gravel around the home as well. And so those other factors introduce further complications to building a product like this. And I think obviously we talk about like the whole home insurance market, right? Like, I mean, that's also another tricky component because you have a lot of existing home insurance carriers where they understand that there are some homes in California that have no wildfire risk or very limited wildfire risk. Um, but like let's just take big carrier, like a lot of big carriers pulled out of the state completely, for example. And so a lot of other kind of MGAs and specialty players came in and said, hey, like let's not write off California completely. Like there are still areas in California that have very, very low wildfire risk where we can still provide home policies for. The tricky part, and David, as you're mentioning, is homes that actually have wildfire risk. And most of that is going to the FAIR plan now, right? And so being able to think about, okay, two things. One, can we build a product that is more reliable and easier to bind and provide coverage for than what maybe the FAIR plan is offering? And then two is the FAIR plan underwriting all the policies correctly? Like, is there room where maybe they're overcharging or undercharging, and can a parametric wildfire product kind of better suit the coverage for those types of risks? So
David,
obviously, as we mentioned, we don't play as much in that space just yet. Still been learning a lot about it, and it's definitely an interesting proposition for us to work on in the future. And I've been spending a lot of time learning about it as well, because it certainly is a problem and will continue to be a high risk.
David, there are lots of nuances with wildfire. I think people throw wildfire into a big basket and say wildfire. Um, One of the things that I think was surprising for many in the most recent round of fires were the propensity of smoke and ash claims. So your house didn't burn down, but you have a massive smoke and ash problem. And the smoke and ash claims can feel a lot more to me like a hail claim. You know, they can be 20, 25, $30,000. You don't have to rebuild the whole house, but you have to get rid of furniture and clothes and things that are permeated with that smell of smoke. I think parametric is very aligned to these types of coverages. Other things like loss of use. If you're getting a mandatory evacuation order and you need to get out of your home, there's ancillary cost associated with that customer for the big peril that is actually occurring or may occur. You may have a loss of use claim with zero damage to your home because of evacuation orders. Another thing that I think parametric is involved. I also think people think generally about homeowners and not renters during a wildfire experience. We happen to front for a very large renters program, and the number of claims, they had no apartment buildings or homes that went up, but they had significant amount of those smoke and ash claims. And so there's all these different nuances that I think is critical. And you can go all the way from excluding fire to excluding wildfire. Most insurance companies have no problem with what I'll call attritional fire, so non-weather driven or catastrophic peril fire. You have the smoke and ash, you have loss of use, you have the total loss because of an actual wildfire. There's so many different nuances, and I think the key is, how do you actually take that exposure and spread it amongst various risk pools? One of the things we do a lot in California at Hippo is we write new home communities. So when a new home community is being built, let's say you're in Santa Clarita and somebody stripped out a big chunk of the desert and they're going to put 1,000 homes out there. Well, they're generally exceptional risks. New homes have a loss ratio that tends to be in the 30s as opposed into the 60s. So there are some people that go, I want to write as many new homes as I can. Yeah, but you don't want to write them all next to each other. You don't want to write 1,000 of them in one community. But if I had 100 risk-bearing partners, and each said, I'll go ahead and write 10 of these in a particular community, that is a much more tolerated risk exposure. So I think you're also starting to see for California wildfire specifically, or wildfire specifically generally, is I think you're seeing alternative risk pools come in to spread that density or lack of diversification exposure. Because again, the loss ratio is generally good, but for what it would cost if you had a major loss. So we're seeing a lot of these different components starting to pop up. Many of them are what are being deemed as insurtech companies or insurtech risk pools. And I think they're the ones that tend to think about how to spread this risk in a more creative way. They also aren't saddled with a massive portfolio of existing homes, because that's the biggest challenge that the larger incumbents have, is they've already got a portfolio that they're trying to manage. If you're starting with a portfolio of zero and building it out from there in a more modern, more risk spreading approach, you have more ability to enact the creativity that you might have.
Right. Rick, since you brought up these regional differences, is there a way, or do you have an opinion on differences between the Midwest or the Plains states, like where Wesley is? Hippo writes in nearly all the states. Some differences between the regional markets, even though the people on this program are mostly Western U.S. Do you have any thoughts about regional differences and maybe even regulatory mindset that's different in the Midwest or the Florida or New England from California?
I have lots of thoughts relating to this. We'll start with the last thing that you said. There are significant regulatory differences from state to state. There are states that generally very much work with the insurance community to try to create better outcomes for insurance companies, because when you create better outcomes for insurance companies, most of them will try to reciprocate those better outcomes to the customer. And so there are significant regulatory differences. The ability to charge predictive reinsurance loads is a great example of one. I know California is starting to allow that. I think there's still a lot of uncertainty on how you can actually put those future reinsurance loads into your rating methodology. That's a step forward to help people within the state of California. So I think there are regulatory differences. There's also diversification. If we go back and we look historically at a state like Florida, Florida is feast or famine. It either has a horrible loss ratio in a given year, or it has a great loss ratio in a given year. And if you look at Hurricane Andrew, right after Hurricane Andrew, almost every major insurer pulled out of the state of Florida. But that void was filled with newer entrants into the market. And then Florida became the most profitable insurance market in the country for the next decade. So there is this idea of how do you actually spread and diversify your exposure? I have no problem writing in Florida. I have no problem writing in Texas. I have no problem writing in California. But I want to make sure I'm not writing too much in any of those areas. And you need to really diversify that exposure. At Hippo, we don't just diversify it with homeowners insurance. If you look at the Hippo home insurance product of the approximately $1.1 billion of premium that we write, it's about a third Hippo homeowners insurance. The other 800 million are non-home related broad products, some property, some casualty, to create further ballast in diversification. So, for all of those of you that are CPCUs, you know this, those of you that are studying, rule number one, try never to violate, is you need to make sure that you have diversification of exposure. And you can be more diversified by a broader component of exposure across different product lines. Now, the trick is, you can't always manufacture all of those things yourself. And so that's one of the reasons, if you look at the whole MGA and fronting market, it is growing exponentially because there are new companies like Wesley's company and other startup insurtech companies that are MGAs, and they need regulated paper, they need an AM Best rating, they need all the different company components in order to put their creative product to market. And so that's why fronting carriers are really gaining traction. These specialty writers are utilizing fronting carriers' capital and rating to put new products into the market. So those fronting carriers are able, if they participate in the risk, to really diversify that exposure. And so I'd encourage people to pay a lot of attention to what's going on in the fronting market, in the MGA market, because it is growing massively and does create more opportunity to bring creative products to market.
Yeah. And I think to add on to Rick's point, I mean, there's just a Wall Street Journal article that came out today that was titled "Runaway Insurance Costs Bring Back the Talk of Price Caps." But again, obviously, this is just like a very tricky situation because if you legitimately look at the loss ratios of those home insurance companies, especially as it relates to home insurance, most of them are not very profitable. And a lot of them, like home insurance for a while, has been a break-even business. It's hard to talk about price caps on home insurance when a lot of home insurance carriers were breaking even in the first place. And so this is a kind of big question of like the future of home insurance. And I know the commissioner in California was talking about how can you kind of talk about how can you talk about an affordability crisis when it might not even be available in the first place, right? And so we need to be thinking about availability with affordability at the same time. And so these are really tricky conversations. And I mean, we're all trying to look out for the homeowner and provide great coverage. But there are a lot of tricky things to weigh in a lot of these conversations.
So I would invite our participants to submit any questions you have in the chat. I have plenty, but we'd love to hear from you as well. Wes, you've been in a lot of states in the Midwest, and would you say that those markets and those regulators welcome your participation, or do they look at you as um, troublemaker? You know,
Yeah.
yeah.
I think I think the insurance industry is really a great industry because I really think that even like without the regulatory component of it, a lot of it is just built off of like trust and relationships, right? And so let's just say like take home insurance, for example, like 50% of home insurance is sold through independent agents. And even if the rest of home insurance is not sold through independent agents, most of it is like captive agents or kind of through insurance companies' platforms. And so as a result of that, I think in a sense, even without the regulation piece, a lot of like working with agencies are almost self-regulating in a sense because these insurance agencies that are on Main Street, they represent their homeowners. They've built out communities. They've built trust over decades and decades with their homeowners. And so these agents also don't want to work with carriers that aren't going to be around in a few years or are troublemakers in a sense. They even without the regulatory piece, and obviously regulators are trying to look out for the homeowner, but the insurance agencies are as well because these are the relationships that have led them to build up their business and kind of survive over the last few decades. And so. In terms of how regulators see us, they've been very supportive. I mean, I know that I've spoken to the Oklahoma insurance commissioner, and he has brought up our company to conversations with insurance agencies about how to deal with high home insurance premiums and our product as a way to manage continuing rising rates. And so. I think ultimately there's a spectrum. I mean, this was a great example of a regulator that like proactively reached out to us and proactively had a conversation with us. I would say others are generally like supportive of what we're doing. And David, to your point, like we're certainly not trying to be a troublemaker by any means, but looking out for the homeowner, providing good coverage at a good affordable rate. And I think so far we've done a really good job of making a lot of people in the insurance value chain happy, which you don't see sometimes with some insurtechs, but insurance agencies, insurance commissioners, insurance carriers, regulators, they've been really excited about what we're trying to build. So.
I think people sometimes forget regulators are consumers too, and their customers too. And if properly explained to them how these new initiatives, these new companies, these new offerings will benefit the consumer, generally you have very good likelihood of getting them to understand and agree. When we started years ago, providing IoT devices to our customers, the feedback we first got is you can't do that. That's inducement. That's violating insurance statute. And so we went to the NAIC. I personally had one-on-one meetings with 21 commissioners or deputy commissioners. And when I explained to them, it's not an inducement, it's a risk mitigation device to help reduce claims in the home, they got it. And I think at that time, something like 18 of the 21 said, yep, you can do it. Just make sure you file it, make sure it's part of an endorsement, and do all these components. So I think really being open and collaborative with the regulators generally help. I think it's when the regulators don't understand what you're doing, that's when they come to their own conclusions. And frankly, I think one advantage, again, I've been in the industry 32 years. I think one advantage of InsurTech is InsurTechs generally think of customer first and then how to benefit the company second. Our industry, although pivoting, has been the opposite of that. The industry traditionally has tried to think about the company first and the customer second. Let's face it, for years and years and years, it still makes the hair stand up the back of my neck when I hear somebody say it. We don't call customers customers, we call them insureds. That's not the right message for the customer. And so I think InsurTech has very much helped the greater portion of the industry realize if there's not a customer at the end of this buying the policy and having positive outcomes, we don't have a business. And I think that has also shifted.
Yeah. So, in the few minutes we have left, Rick, you mentioned you've been around for a little while. What areas are ripe for insurtech disruption? Wes is solving a problem with these very large deductibles where carriers want to share more risk. What are some areas that maybe insurtechs are just getting into, some challenges that we should expect to see insurtech solutions?
Yeah, it's a really good question. I think there are two different areas. One, somebody reminded me when I was at ITC last week that on stage 5 years previous, a similar question was asked of me, and I said there needs to be claims modernization. At the time, there were really no new claims-driven insurtech organizations, whether they were TPAs, platforms, what have you. Recently, in the last 6 months, I know of four claims-driven insurtechs that have gotten funded. So I think that is a real opportunity to really create a better solution for the way that we handle claims. I think the other aspect, and a lot of people will talk about it, and it goes into a lot of different categories, but I do think AI is something that creates better outcomes for customers. One of the reasons I think it creates better outcomes to customers is once you train the AI tools properly, you generally eliminate unconscious bias and you eliminate false information. And so I think giving customers more real-time, accurate, unbiased information creates better outcomes for those customers. It also reduces the cost for the insurance organizations, which should pass some of that cost reduction onto the consumer. So anytime, like I love what Wesley does because him saving, and I'm making the number up, 10% loss adjustment expense, that means his product can be 10% cheaper than what it would be if he didn't have this modern approach to claims handling. So I think those are the two areas. If your company's not using AI, you're already behind. Almost every company that I know of that I would deem as a successful company already have in production AI use cases.
Well, that's a great opportunity to close out our session. The very next session is about AI. So, Wes, I want to thank you for sharing Sola's products and your innovation, and Rick is clearly a big fan of that. Rick, through both Hippo and Spinnaker, your front, you're enabling a lot of Insurtech solutions to get to the market, and I think that's good for consumers. It's good for competition in the U.S. market, and it ultimately is better for everyone in the industry. So, Wes, Rick, thank you so much for your time. I would encourage everyone to take a quick break, and then we'll be back at 9:08.